One of the questions that comes up here as people look forward to what monetary policy is going to be the rest of the year is, where is neutral? Because the Fed seemed to think it was another 50 basis points or so higher, but now we got a pause, so maybe it's come down a little, maybe we're right at neutral. Where do you think we are?
Look, I don't think that anybody knows with any certainty. I mean, this has been an unusual business cycle. Think about how long it's taken us to get back to full employment. I think generally what the Fed is saying that in the language of being patient is that they're going to take a pause and wait for more data. I think there are a number of things that push them off moving to more tightening moves. Number one, you had a tightening of financial conditions. Stock prices went down, credit spreads widened. So that was one concern. Second, foreign growth looked a lot weaker, especially in China and Europe. Number three, there wasn't any inflation. You know, the inflation was the story of the dog that didn't bark. Even though the unemployment rate was low, you weren't seeing any much of an acceleration in wages, and that wasn't feeding into prices. My own personal view is that as long as inflation stays quiescent, Fed will probably be on hold. If, though, the economy keeps growing at above trend pace, more pressure on resources, inflation probably will start to drift back up again. So my best judgment is the Fed's probably not done yet.
Well, how far do they go? At what point do you risk an accident?
Well, that's why I think they're being patient right now. They don't want to inadvertently cause a recession with inflation this low, because people would say, well, what do you do that for? If inflation actually were to accelerate a bit, then they at least have a motivation for why they're moving to a tighter monetary policy stance.
Well, what you did that for was to prevent downturn in the economy, which this group here, according to a survey of NAB members, suggests may come in 2020 or 2021. But the Fed doesn't have a lot of ammunition at this point to fight it.
Well, that's one concern that the Fed is wrestling with is if the peak federal funds rate in this cycle is 2.5%, 3%, 3.5%, there's not that much room between that and zero. And so there's been a lot of discussion among Fed officials and other market observers on, does the Fed have enough firepower to get us out of the next economic downturn? My own view is I think there's more firepower than people realize, because the Fed has invented a whole bunch of new tools to use if they're ever at the zero lower bound again. Forward guidance, asset purchases, open-ended asset purchases. We'll just keep buying assets until we actually achieve our objectives of an actual recovery.
But one of the arguments there is that a lot of that success that the Fed had with those tools came from the announcement value. Now people know the tools are there, so they may not have as much effect.
Well, I think that if let's imagine that we were in an economic downturn and the Fed had reduced interest rates to zero. If the Fed announced that we're going to do by treasuries and agency mortgage-backed securities until we achieve a given unemployment rate objective, that would be also a good commitment strategy. It would make people realize that rates are going to stay low for a long time until the Fed actually has success. And that's actually quite powerful in terms of supporting economic activity.
Has the Fed gotten too intertwined with the markets now? One of the reasons that the Fed, as you just said, went on hold is the market problems and dislocations we saw in December, and now everybody's back to the Powell put. Can you disentangle yourself?
Well, it's tricky, right? Because the Fed doesn't care about the stock market for the stock market's sake. It cares about the stock market because if the stock market were to go down a lot and stay down, it would have consequences for the economy. So there isn't a put in the sense that the Fed is trying to support the stock market at a given level, but there is a put in the sense that if the stock market gets very weak, that has consequences for the outlook and therefore for monetary policy.
Well, they also were worried about the balance sheet. The balance sheet was supposed to be watching paint dry. Did Wall Street get that wrong?
Well, I think all that happened there was the Fed decided that the banks have a greater demand for reserves than the Fed had thought. So that just means that the stopping point for when you stop shrinking the balance sheet is a little bit earlier in time than what they had anticipated. It's not a big policy adjustment. They never knew how many reserves banks were going to demand, and now they're finding out that banks look like they are going to demand a little bit more reserves than they thought. That just means the stopping point is going to be a little bit sooner. But it doesn't have huge consequences for policy.
Does QT, though, have the same effect on the downside that it had?
It doesn't seem to be having the same effect at this point. Part of the reason, I think, is that people still are worried about inflation being too low rather than inflation being too high. So if you look at what market participants call bond term premium, the spread between bonds and the expected path of short-term rates, that's very, very tiny. That's quite different than in past economic cycles.
Now, let me ask you about a point that both Chairman Powell and Vice Chairman Clarida have made in the last couple of days, and that is that the federal deficit is just way too high, and it's going to have an impact on the country. And yet, we've talked about that for decades, and bond rates are not going up.
Well, I think it's partly because you have to look at the U.S. bond rates in the context of rates elsewhere in the world, and we have very, very low rates in Europe and Japan, so that's obviously a factor. And two, people, yeah, I think you're absolutely right. People have anxiety about budget deficits gone down a lot, but I'm sort of where they are. The budget deficit is not only going to keep increasing, the debt service cost is going to start to climb very, very rapidly, because not only is debt growing, interest rates are higher than they've been over the last 10 years. So I think that it is going to be a problem, just not a problem right now.
Well, what do you think of the modern monetary theory, MMT argument, that is getting so much traction these days, particularly up on Capitol Hill lately, that if you print money in your own currency, you don't have to worry about deficits for a while at least? I know it's a squishy definition.
Well, I think they're overstating it. It's true that if you issue debt in your own currency, you don't have to default. So there's no default risk. But there's definitely an inflation risk. If you have too much money chasing too few goods and services, you're going to get inflation, and that would be the consequence. So there, in economics, there is no free lunch. So this modern monetary theory, I'm not buying.
One last question on inflation, and that is, where do you think it goes from here? It disappeared in the fourth quarter. Does it start to come back?
Well, I think it'll probably come back a little bit, because obviously oil prices have recovered. So that's something that moves in and out pretty quickly into the inflation numbers. I think underneath the surface, you're seeing a very gradual firming of inflation, driven really by the tightness of the labor market and the firmness that we're finally seeing in wages.
Enough for the Fed to have to react?
Well, we'll see. It's all this stuff is slow moving, so we'll see. I don't think the Fed's going to do anything in the near term. Second half of the year, maybe the Fed starts hiking rates again.